Hello and welcome. Today we're going to discuss 5 common accounting mistakes that many new business owners make, and most importantly, how to avoid them. As an experienced bookkeeper, I've seen many pitfalls time and again, and avoiding them can save you a lot of stress and money, especially when it comes to taxes. Whether you're freelancing or running a startup or a growing business, these are practical, real-world mistakes you'll want to steer clear of to keep your finances on track and to stay out of trouble with the tax authorities. And stick around for a bonus tip at the end that can become a game changer for your business. Mistake number 1, mixing personal and business finances. Here's the mistake. Using the same account for personal and business expenses or constantly swapping funds between them is one of the most frequent bookkeeping errors among small business owners. It may seem harmless at first. You pay for office supplies with your personal card, or you cover a personal lunch from your business account, but this commingling of funds can create chaos over time. It blurs the line between business and personal finances and makes it hard to correctly determine profitability and deductible expenses. Here's why it's a problem. Mixing personal and business transactions lead to major headaches during tax season and beyond. For one, it complicates your bookkeeping and can cause you to lose legitimate tax deductions, or mistakenly claim personal expenses as business write-offs. If you inadvertently deduct personal costs, you're at risk of audit penalties or legal issues. Tax auditors can deny those deductions and hit you with fines or worse. Your financial reports can also be skewed. With personal costs mixed in, you won't have a clear picture of your business performance. This can hurt when making business decisions, and it undermines your credibility with lenders or investors. In fact, if you operate an LLC or corporation, commingling funds can even jeopardize your liability protection, since failing to separate finances defeats the whole purpose of having a separate legal entity. So, here's what to do instead. Treat your business as its own entity from day one. Here are some steps to keep things separate and clean. Number 1, open a bank account. If you're a sole proprietor, having a separate account and ideally a business credit card exclusively for business transactions will make tracking income and expenses much easier. Number 2, use accounting software to track your expenses. This is what I do for all my clients. Platforms like QuickBooks let you automatically record and categorize your transactions. This way you can clearly label personal versus business expenses and generate accurate reports. Come tax time, you'll easily spot which expenses are deductible and avoid missing any genuine business costs. Number 3, keep good records and document transfers. If you ever do need to move money between personal and business accounts, say you paid with the wrong card by accident, record it properly as an owner contribution or withdrawal. Save receipts and notes for business purchases. It helps you justify deductions and stay compliant. In fact, the IRS explicitly says that any claimed expense should have documentation of amount, date, payee, and business purpose. Good records ensure you don't lose any deductions and you can back up your numbers if needed. And lastly, number 4, regularly review your accounts. As a bookkeeper, I advise doing a quick audit of your accounts every month. This helps catch any accidental commingling early. Number 4, regularly review your accounts. As a bookkeeper, I advise doing a quick audit of your accounts every single month. This helps with any accidental commingling early. If you see a personal charge on a business card, reimburse it and document it. Keeping things tidy as you go means less mess and stress later. So here's the bottom line. By keeping personal and business finances separate, you'll maintain clean books and maximize your eligible tax write-offs and prevent a professional image. It might be a bit more effort up front, but it saves immense time and trouble down the line, especially when preparing taxes or seeking loans. Treat your business finances with the respect they deserve, and you'll be rewarded with clarity and peace of mind. Mistake number 2, ignoring cash flow. Here's a mistake. Many entrepreneurs fixate on profits and sales, but they forget about cash flow, the actual timing of money in and out. It's possible and sadly common for a business to be profitable on paper, but still run out of cash in the bank. So if you send out a big invoice and say $10,000, you might feel great about your revenue, but if that client pays 60 or 90 days later, and meanwhile you have rent and payroll and supplier bills due next week, you could land in serious trouble. In fact, poor cash flow management is cited as a reason for business failure more often than lack of profits. Studies show that as many as 82% of businesses that fail do so because of cash flow issues. Cash is king, as the saying goes. Without steady cash flow, even a thriving business can quickly go under. And here's why it's a problem. Ignoring cash flow means that you're not prepared for timing gaps between money coming in and out. A few common cash flow killers include late paying customers and seasonal slowdowns. and large upfront expenditures, or forgetting about recurring subscriptions that drain cash quietly. If you have a bunch of sales on the books, and if you can't convert them to cash fast enough to cover your obligations, you risk bounced checks or missed payments, or you have to take on debt to stay afloat. In fact, roughly 38% of small businesses that fail end up literally running out of cash. And remember, running out of cash can happen even if your overall profit margin is fine. It's all about timing. As a bookkeeper, I've seen clients with full order books still scramble to pay their bills because their cash conversion cycle was too slow. So here's what you can do. Here's how you can manage your cash flow. Good cash flow management is about forecasting and being proactive. Number 1, create a simple cash flow forecast. This could be a basic Google spreadsheet where you map out expected cash inflows like customer payments and outflows like bills, salaries, and taxes. Project it out at least 3 to 6 months ahead. This forecast will highlight any upcoming cash crunches before they hit so you can plan accordingly. Even if it's rough, update it regularly with actuals versus projections. This habit is vital. Remember, 82% of businesses fail from poor cash flow management, not because their business idea wasn't good. So don't let your business be caught off guard. Number 2, build a cash buffer or reserve. Try to maintain an emergency fund. Even 1 to 3 months of expenses in reserve can be a lifesaver. It might take time to build, but set aside a portion of profits during good times to cushion the slower periods. This buffer means you won't panic if a client is late paying or unexpected expenses pop up. Number 3, you can encourage faster payments. So where possible, you can tighten your credit terms. Instead of doing a default net 30 days, consider asking new clients for net 14 or even upfront deposits. Offering early payment discounts or tools like online payments via credit card or ACH can incentivize customers to pay sooner. The quicker you get cash in hand, the better your position. More on invoicing in the next section. Number 4, monitor and control spending. Keep an eye on outgoing cash. For example, track those subscriptions and software fees. Are you still using all those services? Cut unnecessary expenses to improve your net cash flow. And if you have large purchases to make, plan their timing when you know that cash is sufficient, or see if you can spread out those payments. And number 5, have financing backups. It can be smart to arrange a line of credit or a business overdraft before you desperately need it. These safety nets can cover short-term gaps. Use credit carefully. It's a tool, not a crutch. The goal is not to mask a perpetual cash flow problem with loans, but to have an option when timing mismatches occur. And here's a fun fact. Even big businesses sometimes use credit lines to manage seasonal cash flow swings. The key is they plan for it rather than react in panic. So remember, a profitable business can feel like it's one slow payment away from disaster if cash is not handled right. By forecasting and managing your cash flow, you'll avoid the nightmare of being caught short. Good cash flow management doesn't mean always having a huge surplus. It means knowing your numbers and timing, so you're never blindsided. As a bookkeeper, I can't stress this enough. Stay on top of your cash flow. Mistake number 3, ignoring taxes until it's too late. Here's a mistake. No one loves dealing with taxes, but pretending they don't exist until the deadline is looming, or worse, already passed, can cost you big time. Many new business owners procrastinate on tax filings or payments, which can lead to missed deadlines, and the result? Automatic fines, interest on what you owe, and even red flags with the government. In the US, the IRS charges 2 separate penalties, one for failing to file on time and one for failing to pay on time. The failure to file penalty is 5% of the unpaid tax per month, up to 25% max, and the failure to pay penalty is 0.5% per month. These can stack up quickly, and interest gets added on top of that. In short, ignoring tax deadlines can drain your hard-earned money for nothing, and signal to authorities that your business management is poor. Here's why it's a problem. Besides wasting tax on penalties and interest, missing deadlines can trigger further scrutiny. Governments often impose harsher fines the longer you delay. In the US, if you're significantly late, the IRS can even issue liens or levies on your assets. Moreover, from a cash flow perspective, tying back to mistake number 2, getting blindsided by a large tax bill at the last minute can be a nightmare. I have seen business owners who didn't plan for taxes throughout the year, and then they struggle to pay a big surprise bill, which can lead to, you guessed it, more penalties for the late payment. It becomes a vicious cycle. So if you're scrambling at the last minute to get the documents, it means that you're more likely to make errors on your tax return or miss deductions that you could have claimed. It's a recipe for overpaying on taxes and making mistakes that might require amendments later. So here's what you can do. Number 1, know your obligations and dates. Make a list of all your tax filings and payments relevant to your business. This might include your number 1 annual income tax return. This is Form 1040 with Schedule C for sole props or 1120 for corporations. It's due April 15th or March 15th in the US. Number 2, this might mean your quarterly estimated taxes. If you're self-employed in the US, these are due April, June, September, and January 15th. This might mean your sales tax or VAT returns. This is often quarterly or monthly, depending on your jurisdiction. And this might mean your payroll tax filings. This is Form 941 and it's filed quarterly. Each has its own deadline. Mark all of these off on a calendar well in advance. Set multiple reminders. Do not rely on memory. Number 2, create a tax prep routine. Rather than dumping a shoebox of receipts on your desk on April 14th, build good habits throughout the year. This is what bookkeepers do. They help you year-round. For example, reconcile your accounts monthly. See mistake number 5, which is coming. And update a spreadsheet or software with income and expenses categorized for taxes. Keep digital copies of important documents, like receipts and invoices, in an organized folder or app. When it's time to file, you won't be hunting for that one missing receipt or scrambling to total up deductions. Number 3, use tools and tech. Leverage your tax software or accounting software, like QuickBooks. They often have features that alert you to upcoming deadlines. Number 4, budget for taxes. Put 20 to 30% of each payment in a separate tax savings bank account. So that way, when it's time to pay the tax man, you have the funds ready and won't be scrambling or tempted to pay late. And number 5, communicate if you're in trouble. If despite planning you can't file or pay on time, don't bury your head in the sand. Most tax authorities are surprisingly willing to work with you if you reach out proactively. For instance, if you inform the IRS or your local tax office early, they can often grant extensions or set up an installment payment plan. In my experience, they're much more flexible if you contact them before missing a payment. Because remember, penalties for not filing are usually heftier than for not paying. So even if you can't pay in full, still file the return on time and work out the payment separately. This alone can save you plenty of money and avoided penalties. So in short, treat your tax deadlines as non-negotiable appointments. Mark them, plan for them, and check off the obligations one by one. By staying organized and ahead of schedule, you'll avoid needless fines and save you thousands of dollars that can be reinvested into your business. And you'll maintain a good compliance track record. Your future self and your wallet will thank you for not procrastinating on taxes. Mistake number 4, late invoicing and poor credit control. Have you ever finished a project or delivered a product and then waited weeks before sending the invoice to the client? Or perhaps you sent the invoice on time, but then you were too busy to follow up when payment was late? Many business owners, especially freelancers and service providers, fall into this trap. Every day you delay invoicing or hesitate to chase an overdue payment is basically giving an interest-free loan to your client. You did the work, you deserve to be paid on the agreed time. Late invoicing and lax follow-up on receivables can strangle your cash flow and ultimately your business. It's a global issue. Freelancers and small business owners around the world suffer from late payments habitually. In fact, data shows that half of all invoices to U.S. businesses are paid late, and on average, small businesses receive payment 8 days past the due date. That's a full week or more beyond what was agreed, which can be critical if you have your own bills to pay. Here's why it's a problem. Late payments can equal cash flow pain. When clients don't pay promptly, you might end up unable to cover your own obligations. It can force you to dip into savings, delay important purchases, or even borrow money to fill the gap. Essentially, you become your client's unwilling bank. Moreover, the longer a bill goes unpaid, the less likely you are to ever collect in full. Some statistics indicate that after 90 days, the chances of collecting an overdue invoice drop significantly. And on top of that, think of the time wasted. Small business teams reportedly spend an average of 14 hours per week chasing late payments. That's 14 hours not spent on productive work, marketing, or improving your services. For solopreneurs, that's nearly 2 full workdays a week lost to playing bill collector. And if you're not reconciling, which is mistake number 5 coming ahead, you might not even realize which invoices are overdue until much later, compounding the issue. So here's what to do. You need a solid invoicing system. Number 1, Invoice immediately and clearly. Don't wait until next week or month to bill a client once you've delivered your end of the deal. Get into the habit of sending the invoice right after the work is delivered or at the agreed milestone. The sooner the clock starts on the payment term, the sooner cash arrives. Make sure your invoices are clear, professional, and include due dates and payment terms upfront. Instead of the default 30 days, consider shorter terms, like payment due in 7 days or 14 days for clients that you trust. Many will follow that if it's the stated expectation. Every extra day you give is basically a free extension of credit to the client, so be mindful of what makes sense in your industry. Number 2, set expectations with clients. Communicate your payment terms before you start the work. For larger projects, you might even negotiate a deposit or a milestone payment. For example, 50% upfront or 50% on completion. Having skin in the game, the deposit, often makes clients more responsive. Also, don't be shy about implementing a late payment policy. Your contract or invoice might state that late payments incur an X% monthly interest or flat fee. While you might not always enforce it, this having it stated can encourage timely payment from businesses that know the drill. Number 3, use tools to automate invoicing and reminders. Take advantage of invoicing software like QuickBooks, which allow automatic reminder emails. For instance, you can set up an automatic friendly reminder to go out the day after an invoice is due and another week later, etc., escalating in tone. This takes some awkwardness out of the chasing. It's the system nudging them, not you personally every time. Some clients honestly appreciate the reminder. Number 4, offer easy payment methods. The easier you make it for clients to pay, the fewer excuses they have. Accept online payments if possible. Services like Stripe or PayPal or bank ACH transfers can let clients pay with a click. Yes, there might be a small fee, but consider the cost of getting your cash faster. For recurring clients, you can even set up auto billing or direct debits. Do something like Go Cardless so that payments are pulled on the due date. The convenience can dramatically improve how fast you get paid. For example, accepting credit card payments might mean you pay a 3% fee, but it means you get the money immediately rather than 30 days late or never, so it's often worth it. Number 5, be consistent and prompt in follow-ups. Develop a follow-up system and stick to it. So for example, if it's been a day after the due date, send a friendly reminder. Hey, just checking if you received this invoice. It was due yesterday. Let me know if there are any issues. If it's been a week later, send a slightly firmer reminder. This is a reminder that this invoice for this amount is now 7 days past due. Please arrange payment immediately or contact us to discuss any problem. Some accounting software can send this out automatically, but if you do it manually, set these reminders on your calendar. If 2 weeks pass, you might have to escalate, perhaps a phone call to the client's AP department or to the client directly. For high-value invoices that go a month or more overdue, you may need to consider stronger actions, like mentioning that continued non-payment will force you to pause work or consider legal collection. It's uncomfortable, but remember, you deserve to be paid for the value that you provide. Polite persistence is the key. You'll find that the more consistently you enforce your payment expectations, the more your clients, even the slow ones, will prioritize paying you on time because they know you're staying on top of it. So all that said, by tightening up your invoicing practices and staying on top of receivables, you can significantly improve your cash flow and reduce stress. But remember, you are not a bank, you are a business owner. Getting paid timely is not rude, it is business standard. In fact, many clients, especially the larger firms, almost expect you to chase. It's just part of the process. So don't feel bad about it. Be professional but firm. Your business's health depends on cash coming in promptly. On a personal note, as a bookkeeper, I often assist my clients in setting up such systems, from invoice templates to automated reminders, because I've seen how much of a difference it makes. If you implement just this change, you might see tangible improvement in your cash flow within a couple of months. Mistake number 5, not reconciling accounts regularly. Here's a mistake. Some business owners only look at their books once a year right before tax time, or sporadically every few months. They're not regularly reconciling their bank accounts, credit cards, and other financial accounts. Reconciliation means making sure that every transaction in your bank statement matches your own records and vice versa. Skipping this routine is like never balancing your checkbook. You think you know your financial position, but errors or omissions could be lurking. If you wait until year end to discover discrepancies, you'll have a huge detective project on your hands trying to remember what that mysterious $137 charge back in March was for. Unfortunately, failing to reconcile frequently leads to inaccurate books, which can snowball into bigger issues. So here's what's the problem. When you don't reconcile at least monthly, a few things can happen without you noticing. Number 1. Missed income. Say a client's payment got lost or didn't clear. If you never cross-checked your bank deposits against your invoices, you might never realize you were never paid for something. I've seen cases where a small business owner forgot to bill a client, and because they weren't reconciling, it slipped through the cracks entirely. Ouch. Number 2. Unrecorded or duplicate expenses. Similarly, some expenses might hit your bank but never got recorded in your books. Or you might accidentally enter a bill twice. These mistakes can mean your financial reports are off. You could be underestimating your costs and get a nasty surprise when the bank balance is lower than expected, or overstating them, and then overpaying on taxes because you didn't deduct everything that you could. Number 3. Bank errors or fraud go undetected. Banks are not infallible, and certainly fraudsters are always probing. If a weird charge occurs or a check gets altered, the only way you'll catch it is by reconciling your statements. Waiting 13 months to notice a rogue transaction could mean it's harder to resolve, and maybe even too late to dispute with the bank. Regular reviews help you catch unauthorized transactions or mistakes early, when you have a better chance of correcting them. Number 4. Cash planning suffers. If your accounting software says you have $10,000 in the bank, but the actual bank account only has $8,000, or vice versa, you might make spending decisions based on bad info. So your non-reconciled books can equal unreliable numbers, and unreliable numbers can lead to poor decisions, like thinking you can afford that new equipment, but in reality, you can't. And number 5. Tax compliance and audit risks. Accurate books are the foundation of accurate tax returns. If your books have errors because of unreconciled accounts, you might underreport income or overclaim expenses unknowingly, which can lead to compliance issues. Conversely, you might miss deductions because the transaction was never reported properly. Keeping things reconciled means come tax time, you can confidently provide figures that are accurate and complete. With proactive record keeping and monthly reconciliations, you help ensure tax compliance and can maximize your deductions, while also detecting errors and even potential fraud. So here's what to do. Number 1. Reconcile monthly. If your business has a lot of transactions or very tight cash margins, you might even need to reconcile weekly. The more often you do it, the quicker each session is. Think of it like laundry. Doing a small load every few days is easier than tackling a giant pile at the end of the month. Frequent reconciliation means that you're always working with up-to-date information, and any issues can be addressed promptly, not 6 months later when memories have faded. Number 2. Use software and automation. Modern cloud accounting software like QuickBooks Online can connect to your bank and import your transactions automatically. This makes reconciliation much smoother. After connecting, you basically just approve matches or add missing entries until your book balance and bank balance agree. Number 3. Investigate discrepancies immediately. If something doesn't match, say your records show a payment from a client on the 12th, but the bank shows nothing, or the bank has a fee or charge you didn't account for, dig into it sooner rather than later. By checking now, you can chase down the issue and ask the client or call the bank, but if you wait too long, you may forget details or lose the paper trail. Early investigation can also catch signs of fraud. So for example, regular reconciliation is one of the best tools to detect unauthorized withdrawals or embezzlement. Many small business fraud cases, unfortunately, have been uncovered because the owner finally looked at a bank statement after months and saw an odd transfer. Don't let it get that far. Reconcile often and question anything that looks off. Number 4. Keep notes and attach receipts while memories are fresh. As you reconcile, it's smart to attach digital copies of receipts to every expense in your software and write a brief description if it's not obvious. So for instance, if you see a $50 charge at ABC Services and you recall it was for office cleaning, note that. Future you or anyone reviewing your books will greatly appreciate the context. If a transaction looks completely unfamiliar and you can't reconcile it, flag it and perhaps reach out to the bank for details. It could be a bank error or fraud if we don't recognize it. And lastly, don't ignore small differences. Sometimes you might be tempted to say, oh, I'm off by $20, close enough. But that $20 difference could be number 1, a bank fee you didn't record, number 2, interest that you earned, or number 3, a missed transaction that happened to net $20. Always track down differences no matter how small. Often, Often it's something simple, but it ensures your books are fully accurate. Remember, a proper reconciliation means that your records and bank statements are in complete agreement down to the penny. If they're not, find out why. It's like solving a little puzzle. Once everything clicks, you can be confident your financial statements are accurate. Regular reconciliation is truly a game changer for small business finance. It gives you confidence that you know exactly how much cash you have, which prevents scenarios like thinking you have more money than you do, which could lead to overdrafts or bounce checks. And it also means that your financial reports will be reliable, crucial if you need to show them to a lender or investor. So clean, reconciled accounts make it much easier to apply for loans, attract investors, and plan for the future with confidence. And if you ever face an audit or need to produce records, you can do so without panic because everything is organized. If this task is too tedious or time-consuming, consider hiring a bookkeeper like me. Many business owners hand off reconciliations to a professional so that it specifically never gets neglected. It's a mundane task, but it's essential for your financial peace of mind. And here's the bonus mistake number 6. Get experienced help early on. We've gone over 5 big mistakes to avoid, and here's the bonus mistake, but it ties all of them together. Don't wait too long to consult with an experienced bookkeeper. The earlier you seek professional guidance, the fewer headaches and costly mistakes you'll have later. I often hear from entrepreneurs, I'm a tiny business and I can't really afford a bookkeeper or accountant right now. It might seem like an expense you can put off, but even a short consultation or a basic setup with a pro can save you tons of time and money down the road. Here's why this matters. When you're just starting out, an experienced bookkeeper can help you set things up correctly, from choosing the optimal business structure for tax purposes, to registering for the right taxes, to implementing the accounting software tailored to your needs. These early decisions have lasting impacts. For example, the difference between operating as a sole prop versus an LLC or S Corp can have significant tax and liability implications. A professional can explain this and get you on the right track before you accidentally run into issues. Another example, ensuring you're aware of all the mistakes you need to file, so no surprise deadlines as in mistake number 3, or whether you need to collect sales tax, etc. It's much easier and cheaper to start compliant than to fix non-compliance later on with penalties. So here are some tax-saving opportunities. Professionals do more than data entry. A good bookkeeper will aim to become a partner in your business growth. They can spot tax-saving opportunities you might not know about, like available credits or deductions. Did you know that, for instance, that many business owners miss out on deductions simply because they weren't tracking the expenses or didn't know they qualified? Think home office or mileage or certain startup costs, etc. One industry study even suggests that 90% of business owners overlook some eligible write-offs. While that number may be high, it underscores the point. You don't know what you don't know. A bookkeeper's expertise ensures you're keeping every single dollar you're entitled to. In fact, by avoiding tax penalties and capturing all deductions, a good bookkeeper can potentially save you thousands of dollars, often more than their fee, which I guarantee. And if you recall mistake number 2 about cash flow, a pro can help you analyze cash flow patterns and suggest strategies like adjusting pricing or payment terms to improve your liquidity. And what about focus and growth? Hiring a bookkeeper can free up your time being spent on growing your business. Studies have shown that a large portion of small business owners handle their own bookkeeping, with many spending 80 plus hours a year on it. That's 2 full work weeks, and 60% of owners admit that they aren't knowledgeable in accounting, which just means that they're spending that time inefficiently and possibly making mistakes. So by outsourcing this function or getting help, you reclaim those hours. You can dedicate them to sales, marketing, simply delivering your product or service. Moreover, you gain peace of mind knowing that your books are done correctly. So when should you get help? Honestly, as soon as possible. If you're brand new and truly can't budget for ongoing bookkeeping, at least consider a one-time 15-minute consultation. I can offer an hour or 2 of my time at a reasonable rate to review your setup, give advice, and ensure that you're on the right path. And I can even set up your QuickBooks chart of accounts and show you how to report transactions properly and remind you of upcoming tax requirements. This small investment up front can prevent the scenario of having a completely tangled mess of books a year later that requires extensive cleanups. I've had new clients come to me with literal bags of unopened bank statements and receipts from the past 2 to 3 years. Trust me, it costs a lot more to untangle that than it would to have just maintained it regularly and get guidance early on. Also, a bookkeeping professional can be a sounding board for financial decisions. Are you thinking about hiring an employee or buying equipment? I can help you budget for it or consider the tax implications, like Section 179 deduction on equipment or any tax credits for hiring. But if you're considering pricing changes, I can help you analyze your margins and how that affects your bottom line. Basically, you get a knowledgeable partner who understands your numbers so you can make informed decisions rather than guesses. And according to a report in QuickBooks, 3 out of 10 business owners have made a significant tax or financial error in their business. With a professional by your side, you greatly reduce that risk. So, how do you find the right help? Well, you look for a qualified, experienced bookkeeper like me. The key is trust and communication. You should feel comfortable asking questions. And what about the cost versus benefit? Yes, hiring help does cost money, but think of it this way. If you value your own time at, say, $50 an hour, and you're spending 10 hours a month on bookkeeping, that's $500 every time. If a bookkeeper charges you $200 a month and does it in far less time and more accurately, then you save money and you freed yourself to possibly earn more revenue in those hours. And what about the potential savings from optimized taxes and avoiding costly mistakes? Those can be significant. So in summary, getting experienced help from a bookkeeper is one of the best investments you can make in your business. It's like getting a financial co-pilot. You still steer the ship, but they make sure your navigation instruments are working and you're not flying blind. Whether it's a one-time setup or ongoing support, don't hesitate to seek that help. Personally, I offer remote bookkeeping services for exactly this reason, to help business owners like you focus on what you do best while I handle the numbers. Even a small dose of experienced guidance can save you from big mistakes and unlock tax savings. Bookkeepers like me help you stay compliant, find tax advantages, and free up your time to grow your business. If you find these insights helpful and you're thinking, I could use some help with this kind of stuff, then let's talk. Click the link below and we can set up a 15-minute free consultation and I can see what I can do for you. As an experienced bookkeeper, I specialize in helping new and small businesses implement all the good practices that we discussed today. I can help you in setting up separate accounts, getting a handle on your cash flow, and keeping you on track with taxes, streamlining your invoices, and maintaining squeaky clean books through regular reconciliations. Basically, I'll handle the financial headaches so you can focus on running and growing your business. Imagine having financial peace of mind, knowing your books are accurate, your taxes are handled, and your cash flow is under control. That's what I strive to deliver to my clients. If you want that for your business, reach out to me and let's have a 15-minute conversation about how I can become your bookkeeper and financial partner in success.